Hey everyone, it's John at Rain King LLC. It's April 7th, 2023. Time for a general market update. So as a reminder, this presentation is made by Rain King LLC, and I am an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So the agenda today is a quick overview of the context. I'm going to get into the indices, and then Einstein or Churchill, which one are you? And a quick summary. So let's get into the context. This is just a weekly chart of the S&P 500. Not a lot of change since last week. You'll notice, though, that the downtrend line from the bear market was broken. And then when we had our first pullback, it really came down and actually touched that line and got support. We had a big volume week here of support. We've had 3 other weeks of support amid the banking crisis. And this week, which was a shortened week, was on lower volume. So this is a chart put together by Charles Schwab. And what it's showing is really the narrowness of the market. This is the S&P 500, and it's separating in blue are the top 5 components of the S&P, and the gold is the other 495. And you're looking at the performance, and you'll notice in January, the top 5 were up 10%, and the remainder was up about 7%. You can see how that's really changed in March. In March, we had really a surge in the top 5 and very little progress in the remaining 495 stocks in the S&P. It's just another way to look at the narrowness of the market and the breadth, which has deteriorated for a while now, and we're hoping it gets better. This is the AAII bull ratio. This comes from Sentiment Trader. Now, this is looking at a green line, which is a rolling 100-period moving average of the American Association of Individual Investors sentiment reading, which is basically retail investors. And you can see a very, very long-term chart. And what it's basically saying is we have excessive pessimism. This is the number of bulls, and you can see the number of bulls is below 45, which is one of the lowest readings we've ever had. So there's definitely a lot of pessimism in the market, and on a sentiment basis, that's a good contrarian indicator, though we would never use it as our primary source of decision making. So I pulled up this chart. I last showed this back in February, and this again is from Sentiment Trader. The premise was basically when you have the S&P 18 days above the 200-day moving average after a 20% decline in the markets. If you can get above it for 18 days, essentially the market never made a new low in the bear market. So it just was speaking to odds. I went back to it and looked at where we were now. We actually achieved 31 closes before or above the 200-day moving average before we broke it and closed below it. So I looked at some of the forward-looking gains. 1 week later, 2 weeks later, and 1 month later, we have these readings now. And when you look at them compared to the historical signals, we're kind of off to our worst start ever. But I wouldn't take it too seriously, because the context of this particular study is about the market making a new low in a bear market. So even though it's gotten off to a slow start, the premise still holding right now that we would not make a new bear market low given this type of data. This is the S&P, the percentage of the stocks that are above the 200-day moving average. One way to look at breadth. It was really bad a couple of weeks ago. We talked about how it deteriorated very, very fast. In early to mid-March, we had the banking crisis, which put a lot of fear in the market. Over the last 2 weeks, though, we've seen a number of different stocks coming back, and we actually have improved the number of stocks percentage-wise above the 200-day is now up to almost 57%. Hopefully we can consolidate here and actually keep moving higher. We typically want to see bull markets are usually with it's above 70%. We got there in the early part of the year, but we couldn't hold it. So let's get into the market indices. This is the S&P 500. This is a daily chart. A couple things I just wanted to point out. We came up here, and we've actually entered this really a resistance zone. You can see from 4,100 to 4,200 is a zone of resistance, important resistance on the S&P 500. Every time we've gotten into that kind of box, things have been rejected or they didn't go much further. We got to 4,200 here. So it's an important to be aware of this as we got to the lower end of the box and we got rejected. And, can the market regain its footing and do some consolidating and make a run at higher highs? Noted on the chart, we've had an uptrend, though a very sloppy, choppy uptrend of higher lows, higher high, higher lows, and we're looking for another higher high. If we can really get above this box, that would be very, very bullish. Now, we know that on the breadth, we need some work to do. This is new highs in green and new lows in red. This is still not a healthy picture. New highs are barely in the green, and recently we had new lows increasing. So this is really not helpful, and we need to see this really, really improve. So this is the NASDAQ, a daily chart from April 7th. Now, we had a really good signs last week. We actually had 2 follow-through days, which looked very, very encouraging, but the rest of this week has not been encouraging at all. Now, I say in the footnote here, tech is getting gradually stronger, though it is still a pretty narrow market. We know that the mega caps are leading the index, and we need to see more participation under the hood, so to speak. I've also noted you kind of the resistance area that we're in with the NASDAQ. We've gotten into this zone here in orange. You can see where it's been logically, there's been rejections multiple times, and we've been rejected since last Friday's move. Now, hopefully, again, we'll hopefully want to see some consolidation and a move to a higher high. Now, one of the reasons I think it's getting stronger is one way I can look at it is I would evaluate that selling pressure in the NASDAQ is getting less and less with each correction. So what I mean by that is this first decline came down to the December lows. It was a decline well below the 50-day moving average. So if we use that as a gauge of how much selling pressure there is in the index, you'll notice that correction number 2, we did break the 50-day moving average, but not a huge amount. It was less of a break of the 50 than we had in option 1. And you'll notice that right now we're pulling back. And even if we pulled back down to the 50-day moving average, and if we got support and consolidated around the 50, that would be another improvement as selling pressure on the market is gradually getting less and less, and the NASDAQ is starting to turn. So that's an optimistic way to look at the chart if you're really trying to monitor how much selling pressure. Now, Einstein or Churchill. So you'll have to identify yourself as being one of these camps. So what do I mean by that? So Albert Einstein had this quote. He said, "Insanity is doing the same thing over and over and expecting different results." So let's put this in the context of the market. Right now, the way the market's been going with this chop, you say, geez, you got me going in, you got me going out. It's really been a struggling, difficult market. We constantly are starting to try these pilot positions. They start to work, and as soon as you make a little progress, they fail, and you get stopped out. So you're probably experiencing some frustration. You're probably upset as stops are getting hit. Particularly if multiple stops are hit in one day, as was the case this week. I had a couple, 2 to 3 stocks that were stopped out myself. So it's frustrating. It's really difficult. And then you could say, look, for the past at least 6 months, you've been taking pilots and they're not working yet. Now, it's important, try to maintain your focus on the big picture. And the big picture is, you protect your account when you're getting negative feedback. And even though last Friday, end of the week, we had 2 follow-through days, we had some pretty negative action during the week. You've got to back away and be flexible. It's all about positioning. If you bought extended, or maybe you added to positions too aggressively and moved your average cost too high, you felt the pressure on the pullback and these couple of bad days that we had in the market. And really what you have to say to yourself is, maybe our timing is simply a little off with the general market. and our timing is off. Maybe our positions, the stocks we're picking are probably going to be big winners, but we have to protect our account when we're getting negative feedback. Now, maybe you're a Winston Churchill, in the sense that he said success is going from failure to failure without a loss of enthusiasm. Now, stops are important. Stops protect us from deeper drawdowns that can really destroy an account. Now, you have to really think about this. Watch, we want to observe the market, and we want to continue to look for stocks that are setting up, and we want to use our observations of the market for our timing. Because we know that when the real bull market kicks in, we're going to be there to capitalize because we've stayed engaged with the market. We have watch lists ready, and we're watching the market action. Now, it's important to remain optimistic. What I mean by that is you're still building your watch list. You're not getting disengaged, and you continue to do your daily routines. You do your weekly routines, and you're enthusiastic. You know that the payoff will be there in the end. So I wanted to turn to probably the leading group since the beginning of the year, and that is the semiconductor. So I've pulled up the SOX, the ETF, and this is a daily chart. And you'll notice that the SOX, very similar to the NASDAQ, has pulled into this kind of area of resistance. You can see this orange band. Each time we've gotten into that area, we've had rejections, and we just about cleared it at 440, and then we got slammed back this week all the way down to the 50-day moving average. So when you start to look at some of the individual names in the semiconductor area, you can see that there actually has been probably about 2 weeks of distribution in individual names here and there showing up on the charts. But in general, it's been on lower volume. So you have to wonder if the lower volume is telling you that there's not heavy selling in semiconductors, at least not yet. And maybe we're going to base out and build a little launching pad here to push through, which will probably push the NASDAQ through its point of resistance as well. So let's look at this a little further. Now, looking at this semiconductor group, one of the nice things about these pullbacks is it gives us an X-ray into finding out who are the real leaders in the group. So where should our focus be? And one of the ways to do that is look at the pullbacks and see where they're getting support. Now, Rambus and NVIDIA have only pulled back to the 10-day and the 20-day moving average, respectively. That's very good action. They're still acting very, very strong. Now, AMD, Lattice Semiconductor, STM, they've pulled back. They're kind of between the 20-day and the 50-day. So they're a little weaker. And then you look at some other ones like ACLS, ALGM, SMCI, GFS. They came all the way down to the 50-day. So there's still some selling pressure in those names, but they did get support at the 50-day, which can be a line that institutions try to accumulate stock. Now, probably the weakest of the bunch, Mobileye, ON, Wolf, Lam, and AEHR, you'll notice they're all below the 50-day. So these right now are the weaker of the semiconductor group. So our focus is really watching these leaders. If these were to get into trouble and correct even more, it's possible the whole group might be rolling over, which could be bad for the tech sector. Now, you should do the same exercise for different groups. And I just pulled up a couple of strong names recently and took a look at them, ON, SE, Duolingo, PagerDuty. And these names in here, all of these names got support at its 20-day exponential moving average. So that's, acceptable in an uptrend. Now, some other ones that have been leading, Wynn and Las Vegas Sands and some of the others, and I only pulled a couple here, they came all the way down to the 50. So they're not as strong as the first line. So the point is, I'm pointing out, is you want to look inside the groups and you really want to have that X-ray into which ones are really the leaders and which ones might be secondary stocks within the group. So a few summary thoughts to wrap up. The jobs report came out this morning. It seemed favorable to the Fed's objectives of a cooling economy. Jobs were less, et cetera. Now, what's really important, though, is not the report, but it's going to be the market's reaction. And the market's reaction next week will really tell us if the street likes what they see in the report. Now, keep in mind that it takes time to transition these long, grinding bear markets to transition into a real bull market. It's choppy, it's messy, it's frustrating, but it takes time. So we just have to keep that in perspective, and we want to just be prepared when things do turn for real. Now, the NASDAQ and the S&P have pulled into resistance areas. We want to see them hopefully consolidate in a constructive manner and correct less than the earlier corrections that we pointed out. If we can get a consolidation and we launch through 4,100 to 4,200 on the S&P, that would be very, very bullish because we'd be establishing a higher high, which would mean the uptrend, though sloppy, is intact. So we still need improved participation and improved breadth. The AD line needs to improve. The net new highs, new lows has been very poor. We want to see that really improve because we're not going to make much progress if the market stays really thin. But it's important to keep your eye on the prize and don't let short-term stop-outs and setbacks get you down. It's part of the process. Just keep them as small as you can and manageable, so your account is intact when we do get the real move in stocks. So it's important to stay optimistic. It can be really, really difficult at times when you see things happening in a way that you don't want to see, but try to keep your chin up. We're all going to be there when it really, really turns. So my last pitch, and I'll keep this brief, is the Earnings Reaction Gap Workshop. Next Saturday, April 15th, is the workshop. If you're interested, go to tickermonkey.com. There's a lot of information about what this includes. It's over 7 hours of instruction plus 4 to 5 hours of pre-recorded material. So it's a full 12 hours of material. And we've gotten great feedback on it. And if you go to the website, you'll see a 7-minute video where I describe this in more detail. So I'll leave it there. And that's the general market update for April 7th. Enjoy this weekend coming up, and we'll all get back to work on Monday. Thanks.